The latest is that S&P just announced that it was revising Credit Suisse's outlook to negative from stable. The rationale, they say in a press release that came out just a few minutes ago, is that they believe the Credit Suisse can manage the potential financial losses due to its strong capitalization, robust underlying earnings. But, and this is the important thing where I think we could see more of these potentially, the incident raises questions about the quality of risk management, the group's risk appetite, and adequacy of risk return profile. Also, JP Morgan out with a new note estimating the total damage to global banks as high as $10 billion, Melissa. One of the biggest unanswered questions right now is how did large marquee firms let their client Archegos Capital amass so much risk without blinking an eye, or at least taking a beat to try to understand his exposure and their own? I'm talking about prior to last week, prior to the margin call and subsequent unwinding of the firm. Why were those questions not asked? Now, the risk levels for Archegos' Bill Huang ran well above logic. I spoke with several hedge fund managers who said they could not fathom the type of tolerance, the type of risk tolerance that he had in his positioning. The Financial Times reported that banks were lending to Archegos at ratios as high as 8-to-1. Citing people familiar with the matter, the FT added that in some trades, ratios were as high as 20-to-1. That means it would take a very small move downward in a name to wipe out the whole position. His book was also reportedly heavily concentrated and illiquid by the time we saw the unwinding unfold. As JP Morgan notes, though, Archegos' used equity swaps, and that increased the ability of the prime brokers to see his concentration risk in his various holdings. Now, a spokeswoman for Archegos telling CNBC, quote, "This is a challenging time for the family office of Archegos Capital Management, our partners and employees. All plans are being discussed as Mr. Huang and the team determine the best path forward." Melissa.
There was a quote in an FT article, I believe it was yesterday. I'm going to probably mangle this quote, Leslie, but it said something to the effect of Huang was like a Reddit trader with a Goldman Sachs credit card. I mean, it was just the kind of risk-taking he took was akin to sort of the all-in, let's go, up to the wall. I'll use that phrase instead, with these positions in some of these Chinese internet stocks, as well as Viacom and Discovery, et cetera.
That is a great quote. And it's interesting and worth noting that, in a typical hedge fund structure, you will have LPs or limited partners, investors in the fund, whether it be an endowment, a nonprofit, a pension fund, or whomever, that they kind of serve as almost your boss. They're your clients. They invest in your fund, pay you fees and so forth. And so you have to have certain risk controls in place in your contract with them to ensure that, you are taking the appropriate risk mitigations steps necessary. It doesn't always work. Hedge funds blow up. That happens. But this being a family office, one can assume that the same kind of risk controls may not have been in place, which would allow someone to take the amount of leverage, the amount of risk that he did. So worth distinguishing those two as well.
That's a good point there. Leslie, thank you. Leslie Picker.